TheoTRADE. This is Don Kaufman. It's September 22nd, 2023. Just a few hours after the cash close here on course this Friday afternoon. Markets too big not to fail. Is a tech crisis looming? I'm actually going to cover that and much more here, of course, on this weekend's update. Before I get too deep into it, look, we're going to discuss a lot about some of the volatility following the Fed announcement. Bonds on the verge of a fire sale. SKEW, interestingly enough, goes up with down markets. Disproportionate in terms of market capitalization. I'm going to cover that again, and a confluence of equity, geopolitical, and commodity issues. Before, again, I get too deep into it, I would like to invite each and every one of you to attend live. Check this out, TheoTRADE.com/23. Again, that's TheoTRADE.com/23. This is TheoTRADE's annual live event held at the Opal Grand Oceanfront. That's in Delray Beach, Florida. It is coming to a theater near you. Now, come live. Show up live. Look, November 2nd through 4th. Book your ticket immediately. Book your ticket immediately. In terms of who's going to be there from TheoTRADE, well, it's everybody. It's going to be Thursday. We're kicking it off with a kind of a happy hour and a discussion with all of the TheoTRADE instructors. Friday, obviously, a full day of education. Saturday, a full day of education there. We're going to have the likes of course, myself, Don Kaufman, Jeff Bierman, Corey Rosenblum, Tony Rago, Brandon Chapman, Blake Young. Special guest, Tom Sosnoff. It's been a long time since Tom and I have actually worked at a live event together. And of course, let's not forget Paul from the CME group will of course also be there. Again, it's TheoTRADE.com/23. Come right down here, buy an event pass. Again, step 1, buy your ticket. Step 2, book your room. This needs to be done immediately. Why? We are running out of rooms to book. Again, buy your ticket, book your room now, TheoTRADE.com/23. Let's get back into this weekend's update here. Taking a look first and foremost at some of the damage inflicted to the marketplace. As I said, markets too big not to fail. I'm actually going to provide a little bit of color around that and specifically where you want to be looking in the very near future. So obviously some sell side activity hits this marketplace, right? Volatility starts to pick up. But I like to put that into a degree of context here. Take a look at the SPX, the mother of all products, a rather significant breach of what we term expected move. For those of you that follow us kind of week in and week out, when we start talking about expected move, it's how the option market cap, like the option marketplace handicaps, I should say, forward risk. And in this case, okay, this previous week of trade, the week we just wrapped up today, we were looking for plus or minus approximately $59.55 of a move. Actual move, 2 deviations. I mean, we're there, people. It like literally moved to right to 2 deviations. Instead of moving basically $60, we moved just over 120. It's huge by huge. So we breached, okay, again, the expected move. And if you guys recall back to last weekend's update, literally my parting words to you, do not sell short duration premium. And I was literally saying the exact opposite, be a net buyer of short duration premium. And I got to tell you, that was gold, Jerry. It was gold because we breached in a spectacular fashion. With that came, of course, a big expansion now of implied volatility. So what I'll talk about last over here is, yeah, now after we just saw this big rip, you know, $100 plus move inside of the SPX, okay, we still have an expansion implied volatility, but it's not getting it done. I'm going to leave that for last because that one's going to leave you a little bit of a wanting more, especially in terms of implied volatility. Now, before I go too far, okay, you know, a lot of people are going to point out, all right, it was the Fed announcement lit the fuse for the marketplace to see sell side activity. You know, from where I'm standing right now, I'm looking at the chart over here. All right, so let's just count back. So there's this Friday and there's Thursday, and here's Wednesday. Look, that was Fed day. All right, just want to make the quick point. We are already seeing sell side activity. We are in a significant downtrend prior to the Fed announcement. It was just some follow through. You can say whatever you want. Look, the Fed announcement, rates higher for longer, just push it aside at this point. Again, as I said, any economic indicators coming out are just lighting a fuse. I've been talking about this week in, week out, chocolate covered hand grenades being thrown into the marketplace. Even when you start looking forward, for example, to like next week, and I'll pull the calendar specifically, of course, for next week, and you start digging in over here, any one of these announcements, like durable goods, okay, I'll reiterate, it's just lighting this fuse, and you're going to have to be incredibly careful, specifically around like GDP. That may not look good, okay? Again, what we'll talk about here in a moment is these events. Yeah, it's lighting a like this fuse, but you have an incredible, this coming week, an incredible confluence of equity, okay, political, geopolitical, and commodity issues all converging right now into the end of this quarter. And it is going to be a spectacular end to the quarter. Now, again, the Fed, again, people are saying lit the fuse, but we already just showed that was in the midst of sell side activity. Moreover, if you take a look at the bond market has been in complete like upheaval now for months, just for months. Obviously, after the Fed announcement, we went into steeper sell side activity. But more importantly, if you take a look at the 10-year, and I've warned of this time and again, the 10-year, it even briefly cracked to basically 4.5%. Clearly, we're going to have to be watching this, okay, into the next week of trade. The whole question at this point, it's not about, bonds or recovery. Look, it's just about if the bonds, okay, are going to have a fire sale. And one of the things that really bothers me, and I was talking about this a little bit on Wednesday night's video, and I'm going to talk about it again because it's critically important. I don't like that the volume immediately subsided today on the bond market. I don't like it. I don't have to like it. I don't even want to like it. Moreover, if you take a look at the TLT, and I'll jump to the TLT, look at the volume inside of TLT. Now, the TLT, okay, it's like the ETF version of bonds, and TLT rests somewhere between the 10-year and the 30-year, whatever. Okay, one of the points to be, I guess, grabbed from this is, so why am I looking at volume? I want to see like incredible degrees of capitulation, but volume to me doesn't do it. It's just not enough. So I started looking at like implied volatility and implied volatility percentiles, and I'm bothered by it. Implied volatility, it's not rocking in here. Like, you need to feel the fear, okay? And the question at this point is, are bonds going to be on the verge of a fire sale? You better watch out for this one. In fact, okay, when it comes to the equity marketplace, if you look at the S&Ps, or the S&Ps, people are going to be like, it's an oversold territory. I don't care what you say. Right now, unequivocally to me, is there upside potential to the S&Ps? Yes. Downside risks, though, far outweigh it. If you look at upside potential versus downside risk, the downside risk now is phenomenal. And again, I'm relating the move in the bond market, okay, to reverberate back into the S&Ps and the Nasdaq. And that's what people are not looking at enough. If you look at the 180-day, look at 180-day 1 hour, okay? Bear with me here for a second. Go into futures, hit right here, adjust for contract changes, hit apply, hit okay. What I want you to see, okay, is we're already, through, if you will, this 4,400. We got to latch onto that 4,400 like it was grim death, because right now we're in the abyss. You actually come under 4,400. Any more sell side activity, I'll see you at 4,200. Okay, and that sell side activity, again, it doesn't have to come out of the equity markets. The sell side activity could actually be a little bit of a fire sale inside of the bond market. And I wanted to make that kind of like rational relationship over there, because not enough people are looking. They're just, they're so, myopic. They just look, for what's the Nasdaq doing today? You got to look beyond that right now. You got to be looking at this bond market, because the bond market, again, why a fire sale inside of the bonds? It's not about interest rates anymore. It's not about the Fed, and I can't stress that enough. One more person says, but the Fed fund futures, you got to push it aside. But the economy, you got to push it aside. How about, okay, the very fact that if you are a bond trader right now and you are long bonds, you're getting annihilated. Look at what's going on inside of the bond market. You're getting annihilated in the bond market. That's a 3-year chart. Oh, that's not enough. Pull up a 5-year chart. You're getting annihilated in the bond market. There could be a fire sale in here. If there's a fire sale inside of the bonds, the interest rate's going to spike, not because of anything to do with the economy, not because of anything to do with the Fed. No one cares. You're losing money. They may have to sell their bonds. And in doing so, it'll rock the equity market. And the equity market's already in incredibly dangerous territory that it's through that 4,400 level. Keep it in mind in the days to come. I think it's a critical aspect in there. Now, moving on. A lot of people like to talk about VIX. VIX is in an interesting area. I'm not much of a VIX kind of guy, but I'll explain exactly what I look at here momentarily. But the interesting area here is, as I was saying, like the S&Ps are piercing through what? That 4,400. But at the exact same time, look at the threshold, okay? Tell me that somewhere right around that 18 level inside of VIX, we get above 18, boom, we're going parabolic. Things are going to get crazy. We're at least going to hit 20, if not even 25 inside of VIX. We just got to go a little bit north of that. What often happens in terms of volatility is volatility starts to actually creep up, and then snap, explodes higher. Okay, the average volatility for years too is closer to 20, so it's no surprise to actually see volatility possibly go parabolic. More importantly than VIX, I'm just not, again, kind of a VIX guy. I look at what's termed contango and backwardation. Contango and backwardation deals with volatility futures, and in this case, if you look at OCC vol futures versus no vol futures, right? What do you got in here? About 35 cents differential. And I just want to point this out because we're very close to going from what looks like contango. They'll flatten out and they'll actually flip over to backwardation. That basically means you're in the throes of a much more serious, market turmoil, market move, if you will. Again, we're very, very close to flipping over in the volatility futures. And I'm just going to be forthright in saying I'm surprised by that. And it's what I would call a volatility threat. The S&Ps, they sold off. Let's not get ahead of ourselves. They sold off 200 points in what? I don't know, 6, 7 trading days, whatever. So the S&P sold off 200 points. Yeah, but volatility at this point, this is well-charted territory for the S&Ps. Volatility, though, is at a really threatening place. And one of the areas that kind of surprised me with volatility was SKEW. And even though it was mild, check this out, SKEW actually upticked today. And I was surprised by that. And it's not often that I'm surprised by SKEW, but usually when you get a marketplace, even if it's down mildly, SKEW kind of chills out a little bit, especially after some days of sell-side activity. SKEW upticked today. Again, there's a real threat right now of a sell-off. And I just want to clarify something. Neither volatility nor SKEW is dictating that we're going to go down. It's not. It's not to be used as a directional indicator. It's more, look, volatility is poised to do what? To explode. That doesn't mean that the marketplace is going to sell off. It just means that volatility, is right there looking for it. Now, I want to get to the theme, of course, of this weekend update. And the theme of the weekend update, is a tech crisis looming. There is one thing that is just overwhelming in terms of, bothersome to me. I could spend all day looking at, the S&Ps and like, they sold off, And then I start looking at like financials. Look, the financials, they got whacked a little bit here. Take a look at auto expected moves outside the expected move. Then I went over and I cruised down and I looked at like, energy markets. What did the energy do? Ooh, even energy actually got hit a little bit. Then I started looking at stuff like NVIDIA. NVIDIA, when you start bringing up expected moves, it was barely outside its expected move. You look at like Tesla. Okay, I'll give you this. Tesla got whacked a little bit. But overall, Tesla, pretty mild moves. I looked at Meta. Where's Meta? Meta finished the week massively unchanged. I looked at Google. All right, Google took a hit. But Google is like 3 days removed from its highs. Like, look, it's 3 days removed from recent highs. It's very close to its all-time high in there. I brought up Amazon, Let me actually bring up Amazon. Recent highs, a couple of days removed from it. Bring up Apple. All right, Apple took on a little bit of damage, and Microsoft has taken minimal damage, but is sitting below the 320 level, which has been critical. The reason I am just hammering people about tech, I want you to understand why I keep screaming about, like, look, risk in this market unequivocally is to the downside. And the risk to the downside, okay, it's been there and it's been prevalent, and we just been kind of grinding in the S&Ps, but now it's real. Now it's on. Like, we're ready at this point. Again, it doesn't imply that we are going down, but the risk to the downside is phenomenally large. And why? The market cap, okay, and the proportionate market cap of this magnificent seven, okay, it's going to pull this market apart at the seams. And what I basically am implying by that is you have a $2.3 trillion company. You've got a $2.7 trillion company, right? And that's, again, Microsoft and Apple respectively. Bring up Amazon, it's a $1.3 trillion company. Bring up Google, it's $1.6 trillion. Okay, Meta's good for, what, almost 800 billion. Tesla's good for almost 800 billion. Nvidia is a $1 trillion company. These, okay, disproportional market caps right now, still sitting at or near their highs, okay, is the real risk of the entire marketplace. They start to sell off, okay, the S&Ps are bottomless pit. And it's one of the things that's real. So, of course, people are going to, well, why do they have to sell off? Okay, look, all right, eventually things have tendency to sell off. They don't have to sell off, okay? But we're in a situation right now where the market's actually starting to come down a little bit. If the market continues to come down at all at this point, the disproportionately, okay, weighted market caps are going unequivocally to get hit the hardest. Why? What do you think actually took this marketplace higher? Take a look at the QQQ. The QQQ on a year-to-date basis, okay, still up 35%. Go look at the spiders. Spiders are basically up 13%. Look at the IWM. IWM is basically unchanged on the year. You want to bring up the financials? Okay, the financials are actually down some 2% now in the year. And this is something I was pointing out throughout the course of the summer. I'm going to bring it back up. The energy sector had been down all year long, rallied huge in the last couple of weeks, pulled back. It's only up 5%. You're holding on, okay, the gains on this year completely, okay, based on these big tech stocks. And basically, if there's sell side activity, you hit the largest market cap. So these large market caps become the target exclusively because, well, they're large market caps. I don't care that it's Microsoft or Apple. You got to push aside anything you think about fundamentals right now, and just recognize the reality that sits in front of you is not a good one. And when I talk about things being completely out of alignment and so forth, I mean, you look at something like Costco, which we all know is a big company over here. Costco chicken. It's a $250 billion company. It's an afterthought. It's literally an afterthought. And the biggest financials out there, like JP Morgan, ooh, but still my heart. It's not even half the size of Nvidia. Okay. So they're going to become targets. Again, the Magnificent Seven become direct targets over here. That, as I said, can systematically dismantle the S&Ps. All right. In addition to this, all right, when I call it markets too big not to fail, the problem is what got us higher in these S&Ps were those tech stocks. Okay, and a lot of people made a ton of money buying calls and so forth. Those negative gamma squeezes, right? The exact same powerful, move that pushed us higher can be used to the downside. Negative gamma squeeze does not necessarily imply an upside move. Keep that in mind throughout the course of this next week, and I'll talk about it extensively here on TheoTRADE in the next week of trade. All right, last thing I want to mention over here, okay? As tech might be moving into a degree of a crisis, okay, you're seeing a hit a little bit in the marketplace, but this last week of the quarter, it's almost like the perfect storm over here. You got equity, geopolitical. We're talking about a government shutdown, of course, okay? But push that aside. Let's say it doesn't happen. Who cares? Look at the commodity prices in here. It's ridiculous. Oil, okay, holding its own here above $90 a barrel, okay? Equities are already selling off. We've already talked about volatilities. Bonds, okay, bonds into the end of the quarter. You got to realize that there's a lot of portfolio managers that got to get rid of crap into the end of the quarter, okay? And what? They could fire sale these bonds. That's one of my biggest concerns this week. Compound that, again, with a government shutdown over here. This is ugly, okay? It's the makings of ugly. Does it have to actually make or break this next week? Absolutely not, okay? But again, that, that fuse is kind of lit at this point. All right, moving on over here. Get your trade on this week's profits and losses. Look, I covered some S&P calls. I covered some MES calls, both for 50% gains. Turned around and actually closed a Walmart position for a 30% gain. Turned around and closed a Microsoft position for a 50% gain. I know it's all fun and games, right? Okay, let's actually show you this S&P positions. So the S&P positions, I was rocking in here this week where I actually covered the 4,900 calls, then turned around and actually opened up a new strangle. Right? Then if I cruise over here to Tasty, wrong account here in Tasty, I traded that one heavily as well. Here in Tasty, some of my activity over the last couple of days, I actually covered the 4,750 calls for a 50% profit. I covered the 4,900 calls for 50% profit, opened up a new premium sale, okay, of the 3650, 4850 variety, all the way out to the January 19th expiration. Sold! I turned around, as I said, okay, Microsoft, closed out of my Microsoft position for, again, about a 50% gain. Closed Walmart for about a 30% gain. We are home, people. Again, it was able to unload and sell some decent amounts of premium, though, throughout the course of this week. Nice position here on the TheoTHETA portfolio. Okay, beautiful position here on the TheoTheta small portfolio. Got a couple of nice catapults going in here. Pretty much and a partridge in a pear tree this week. Could not, okay, have been any cleaner in terms of premium selling in those longer durations and buying premium in the short duration. All right, last thing I always mention here, of course, on these weekend updates, SPX Expected Move, often what I term the mother of all products. Okay, one of the first things that I want to mention regarding the SPX Expected Move, huge breach, huge breach, huge breach, huge breach. Okay, look at all of these breaches of expected move. Like, how is that even statistically plausible? Because if you understand expected move, you're supposed to stay inside the range at the end of the week 68% of the time. I'll tell you exactly how it's plausible. We've actually tracked expected move now for years. We have data going all the way back into 2017. And what we often find, there are periods of incredible efficiency, week after week after week of staying inside the expected move. Then the market starts to rip itself apart. Okay, we're clearly in one of the periods where we're ripping ourselves apart. And with almost a 2 deviation move, and it really is a 2 deviation move this previous week of trade, there is something I'm a little bit bothered by. If you take a look at the SPX right now, okay, and we go out some 7 days. First of all, okay, this, which is the September 29th expiration, all right, the expected move is 83 bucks. Now, last week, the expected move is basically 60 bucks. So the expected move jumped a lot. But you realize like an $83 expected move, still, it's not that significant given the fact that we just had, 100, 120 point move inside of the S&Ps. So here's one where volatility expanded. And this needs to be watched very carefully in this next week of trade because, again, don't take my word for it. Watch the expected moves, right? Look that we have, some $83 or $84 move being priced in. Recognize the previous week was only about a $60 move. So when I tell you that there's this almost perfect confluence of events, the SPX is now warning you, okay? Vol has jumped. In my opinion, though, okay, this is where things could get really wild. As I said, that fuse has been lit. At this point now, okay, keep your hands and feet inside of the vehicle at all times. I am not going to scream to you, don't buy options, don't sell options. What you want to look for in this next week of trade, okay, it's not about being like getting on trend or anything like that. It's not about selling short-term options or buying, short-term options. To me, at this point, okay, you watch these volatility futures. And if we start to flip over some sell side activity early in the week, if we start to see the markets move into what's called backwardation, that's when it's on. And that is when we're going to be able to unload and really start to sell some back month premium. I mean, push everything aside over here. Look, if the bonds start to sell off again, okay, it's going to push the equity market over the edge. You're actually going to see the volatility invert. Things are going to get crazy, okay? It's about premium selling at this point. It's not about anything short term. I know that the expected move is up to, 83 or 84 bucks. I get it. But right now, my focus is going to be some of these back month options because this could be, again, one of the best premium selling environments that we're going to get all year long. All right. We're coming in already to the most volatile time of the year. You're the end of the, this quarter, end of September, coming into, of course, October. As I said, there's this just perfect confluence of events. Okay. Bring it. I want to see the volatility. I want to sell some of this back month premium in here because vol, okay, could really get jacked up throughout the course of the week. With that, I want to thank each and every one of you for tuning in to this week's update. Again, markets too big not to fail. Have a wonderful weekend, everybody. Bye-bye.